First one again. Very nice. Very nice. All right, we're gonna give everyone a few minutes to join and then we will get started. All right, we're gonna get started and people can join as we get started. So class today, we're going over support and resistance. What I'm gonna do is let's see here. Okay, so we have multiple different types of support and resistance levels, right? And we're going to kind of talk about how I find my support and resistance levels, how I decide which ones I'm going to use, what levels are important, and so on and so forth. So first, I would say the easiest support and resistance levels you could possibly use are the moving averages. And why I say use moving averages is because they're not subjective. A problem that a lot of people have when they come to try to trade is they trade based on how they feel. Like they trade based on the points of like, oh, this looks like a level, and it's never going to be consistent. It's like, oh, this looks like a trend line. Okay, well, all right, that looks like a trend line, and this looks like it must be support because it bounced there, blah, 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 stuff like that. And people use those and it makes things more subjective. What's not subjective is these moving averages. If you have these moving averages on, everyone's seeing the exact same line as you. So it can't be subjective. Everyone sees the same thing as you. And no matter what, they're going to be looking at the same thing. Like that's just they're going to see the same thing. It makes it super simple, and you see the same thing as what other traders see. Makes your life a lot easier, right? And so that's one of the things. That's the first thing. And I would say the moving averages I use are the 8, the 21, or these are the exponential moving averages. So you have simple and exponential. Simple moving averages. There's this one, and then there's also exponential moving averages. So that's that one. And those are the ones that I use. So the ones that I personally use are the 8, the 21, the 34, and the 50. Those are just personal preference. Those are the ones I like to use. A lot of people will use the 20 if you're using simple moving averages. People will use the 20 simple moving average, the 50, the 100, the 200. It just comes down to personal preference. And so the best way I would figure out to use these for yourself is look on the charts. So try out different time frames or different moving averages and see how the charts react to them. And then you can make your decision based on that. And it will help just visually see it. Like, for example, if we go to look at SPY, you can see this bottom red one here. For back in 2020, when I decided to use the 50 moving average, was when I saw that over and over again, we continued to bounce at the 50 EMA for all of what? Since 2020 to 2021. I noticed over and over again, we continued to bounce off this in the biggest index that there is in the market. And so it was like, okay, that's kind of a given. A lot of people are watching this, so why would I not be watching it as well? And so that's how I made my decision on adding the 50 EMA. And then I kind of naturally added some in, and whichever ones worked best for me, I put them in and used them. And so, for example, like if you look at this, we bounced 1, 2, 3, 4, 5, 6, 7, 8, 9, and that's about it. 9 times within a given year on the daily time frame where we had pretty much a dead low right at that 50 EMA. So it was like, okay, this seems to be an important level that people tend to watch. And so that's kind of why I use the moving averages as support and resistance levels. And because they're indisputable. There's nothing you can do to change those levels, and they're going to be there as long as you have them on your charts. And you can see the 8 EMA is respected pretty well. The 21 is respected pretty well. The 34 as well. And that's just how I decided that I liked these EMAs. I simply back tested, looked at them from prior experiences, and noticed that they worked very well. Nothing, no magic secret sauce to that. It's just that's where I found they worked. Okay, so there's moving averages. And that's kind of just a simple explanation. And these are the most basic support and resistance levels. They are used by almost every trader. You can't have any subjectivity to them because you don't put them on the charts. They are already there. And so they are naturally act as support and resistance levels because buyers and sellers typically will sit there and take positions based on those areas. Okay. So that is moving averages. Now, when it comes to trend lines, so just a simple rule that I use for trend lines is I try to get the most price action within a trend line, but more importantly, I want to have at least 3 touches on the trend line. So like if we look at this trend line here, you can see, let me move this down a little bit, fix that. Oh man, hold on, let me redraw that. Okay, so you can notice we have 1, 2, 3, 4, 5, 6 touches on this trend line. And it's not all about touches, right? That's not the point of this. The point is aggressive moves. Like that's what you want to see. You want to see aggressive moves as a result of hitting this support resistance level. That means there's strong buyers. And just think about it from the most simple perspective. Okay, so we rejected, so like take this level right here. Right here. See this level right here? We came up, hit it, and then fell hard. We rejected hard and came down pretty strong. Okay, that's the first thing. So we see that, obviously. So now think about it from the most basic point of view you possibly can have. Okay, if last time price came to here and it rejected really hard, what's it probably going to do the next time? It's probably going to reject. It might not. It'll either, and I can tell you from experience, most of the time, it's either going to reject or it's going to have an explosive move past it. Once it breaks that level, it's going to be pretty explosive. Okay, so just think about it in the most basic terms when you're creating support and resistance levels. Like, okay, last time we were at this level, we had a big move as a result of hitting that level. Like we came up to it and boom, we shot down. So This is a level to watch because last time we came to it, we had a huge move down. The only subjectivity to this part of it is that you're looking at that you're saying you're judging how big the move is. So the bigger the move, the better the level. So now, like if we go draw this level here, we never really had a great reaction. I mean, we broke through it when we had a big push up. But from there, once we came back below it, we had a pretty drastic move down. Point being that you want to take as much subjectivity out of this as you can. When you look at this, you see, okay, big rejection. We had a strong move down after we came to that level. That's what we can probably expect the next time we come to that level. Just keep it very simple. We had a strong rejection when we came to that level. And now when we come to it the next time, I think either A, we're going to reject again, or B, we're going to have an explosive move through it. Okay. And how I kind of base my trading around this is I'll look to anticipate these breaks and look for a get in before the break and then catch the break when it happens and take profits when everybody's trying to get into their position. Okay. So that's kind of my goal when I'm picking a trade out. Right. And so I'm not looking for the continuation after the break. I'm more so looking for the continuation or just the break, the push up, the strong move up, and catching the premium that from all the buyers. So like when someone gets into an options contract, they are going to, when something is bought up, like if you see a shoe at a store and you like this shoe and you want to buy it, you decide, okay, right now it's $100. I'm going to wait and see if the price comes down. But then a few weeks later, you go back and it's $120. Reason being is because people are buying the shoe at $100 so much that the price is going to go up because the demand is high. That's the same idea that I want for my contracts. I want to get in before the demand gets really high on the contracts. Once that demand gets high on those contracts, I want to be able to sell it. One, because it's more liquid and you can find a buyer easier when you're trying to sell it. Two, when demand goes up on a contract, the price goes up naturally. So you have the price moving in your favor, and you also have buyers trying to buy this contract, increasing the demand, aka increasing the price of the contract. Okay. So that's the idea behind that, right? So it's kind of like, if you think about it, like there's like, say there's a trend in a certain car, right? And people want to buy the car, and let's say it doesn't really matter what car it is, right? But so people, there's a new car that comes out, people really like it, price goes up, or it's a new trend, it's a trendy car. There's a lot of cars coming out like it, but this is the one that everyone wants to have, like an electric vehicle, right? They're becoming the trend now. Now everybody wants an electric vehicle because they're the thing to do now, right? Okay. So the idea is that it's already going with the trend, first of all. It's moving with the trend. And then not only that, you're picking the top of, you're buying it before people want it. And so when people want it, the price is going to go even higher because more people want it. Not only is it going with the trend of what people like, then the demand is going up on that car because more people want it. So then the price goes up as well, in addition to it being a trendy car. I don't know if that's a great example, but I hope you get the idea. Okay, so back to support and resistance. So the main idea is you're looking for spots where price has a big move or a big reaction to it. So this is a prime example. We had a big reaction to this level. Next time we came to it, you can expect something similar, a big reaction to that level. Okay, it's not about touches. It's not about anything else. It's about, for me personally, it is about what was the reaction to that level. Okay, so if it had a strong reaction, that's what I'm looking for. That's the level I want to pay attention to. Okay, so same thing goes for trend lines. Now, trend lines, I want to see multiple touches on the trend line because that will make it valid. Like a trend line, like if you just have one strong reaction, then you would just draw it as a level, right? Like this has one strong reaction. I'm not going to draw it as a trend line because it was just one strong reaction. But once it starts to create a trend, then I'll create it as a trend line. Like there's a difference between this level here, like how there's this one strong reaction and then another strong reaction off it. So that level is the one that's valid. But if you're looking for a trend line, you want to see multiple reactions off this level, right? So you can see we have a strong reaction here. We have another strong reaction here, another strong reaction here, and another strong reaction there. So this makes it a valid trend line. And notice when we break it, we gapped up the next few days after. We had a huge push up as a result. So that's the type of thing I'm looking for on a trend line. Trend lines can be a little harder to draw. They can be a little more difficult to draw, just by nature. So if you don't, you definitely don't have to use trend lines. Like, they are not a end all be all thing. Like, you don't need to have them in your trading. Yes, they help, but I don't think that it is a necessary component within your trading style and to include in your trading. Support and resistance, I think, is pretty important. But you need to use some sort of support and resistance within your trading, in my opinion. You need to have some sort of guideline, right? And so that's how we will draw trend lines and basically put them into use. So we're looking for multiple touches. So like, if we go ahead and write this out. This would be horizontal levels. So that would be like this here. Just for a rule and drawing them, turning point. Major reaction. Major reaction to the level. Okay, so that's the first thing. And then for trend lines, trend lines. Okay, so does that make sense for these two things here? Let me know in the chat if that makes sense to you, so I can go into examples. Good? Yeah, no? Silence lets me assume that you guys are good. Okay, so now when we're going to draw, so let's draw some examples of levels that we might want to pay attention to. Okay, so you can do this on any time frame, does not matter. So here's a level here. Now notice we had a strong reaction here, and we had a strong reaction again. One kind of, I'll take this off to make it easier to see. One thing that you can use to make it more simple for yourself is you can use a line chart. This is a little bit different, and it's going to make it different in the way you see it because it goes based off of closing prices, but it's still the same idea applies. And you can just flip back to the bar chart or candle chart, whatever you use, and draw it based on that. Or so you can go here, okay, and then you go back and say, okay, it was actually right here. So that's how you can go and do it if you need help seeing these levels of strong reactions. So like, for example, you can see a strong reaction here. So now we might need to go back and retrace it and say, okay, it's actually right here. And then we go here. Let's say, let's see, where's another strong reaction? Right here. And another strong reaction here. Another strong reaction here. We can go back and edit the chart as needed, right? So picking the highs. And now you can see kind of how these levels match up. So you can notice once we broke through it, we ripped, came back, retested it, and had a big move up after that. So you can see once these levels are broken, they have really strong reactions. And not only that, they will have strong reactions once they're broken and retested. So those are a few examples there of where you can see it. So we can go to a different chart. Let's go to like Disney or something. Okay. So we can look at Disney. And I didn't pre-plan this, so it's kind of just like, so even though this level hasn't been met, it's a level to pay attention to. Here's a level of strong reaction. Here. Level of strong reaction. And this is how I'll pick my targets. And this is how I'll pick like where my targets are based on these strong reactions where price comes up to it and hits it and has a strong reaction as a result. So this is how I'll pick my targets, how I'll pick my trades, things like that. But yeah, so, and then like, for example, here, let's go back where we can see more price action. Okay, so here, it's a strong reaction. We broke it, retested it, moved up. Strong reaction here, broke it, gapped up. Here's another one. Strong reaction, rejected, rejected. Clear this off. Strong reaction here, rejected, broke above it, had a nice little push up, fake out. Once we broke below, we flushed. And one other thing that I do like to use that I'll mention is that I like to use gap levels as support and resistance as well. So like, see how we have this gap level here? I like to use them as support and resistance as well. So like, if we have you see a big gap here, I will mark the gap levels and use those as support and resistance too, because they usually hold up pretty well. As you can see, we have a nice bounce here, rejected there. Once we broke through here, we flushed, broke through there, we flushed. So I like to use those. And that's really all it comes down to. Like if we go to back to SPY, so we can do a little recap on it. So is this where I put those notes? Nope, is not. Okay, well, we're gonna retype them. So when you're picking support and resistance, basically what you're looking for is SPY. You've got, just to recap real quick, trend lines, 3 touches. And so first you have moving averages. Those are your first support and resistance levels. Second, you have trend lines, 3 touches and three touches and aggressive turning points. Okay, and then you have support or horizontal levels. Which is aggressive. Man, I can't spell today. Aggressive turning points. So this is basically this is what I'm looking for in support and resistance levels. And it's pretty much as simple as that. So like you're basically looking for aggressive turning points in any of these things that you're looking for, right? So like whether it comes to trend lines, whether it comes to horizontal levels, you are looking for spots where there is aggressive turning points. And then that's pretty much it when it comes to picking trades, placing trades, things like that. When it comes to putting, you can use this for entry levels. You can use this for picking targets. You can use this for breakout trades, all those things, just whatever fits into your trading plan, right? And so I told you how I personally use them. I use them for anticipation breakouts. That's how I'll use it. I'll look for an entry below it, or if I'm looking for a break above, I'll enter above it if I'm looking for a break below. But the idea is I'm trying to get in as we break, or before we break the level. All right, so do you guys have any questions or are we good? Because that's pretty much all I have to cover. Good? All right, then. All right, I will see you guys for the markets tomorrow. I'll put this recording up soon. Thank you guys for coming, and I will see you for the markets tomorrow.